In 2025, a dramatic shift in global trade erupted as the Trump administration imposed aggressive tariffs against China, triggering an unprecedented economic backlash. Initially intended to pressure Beijing into trade concessions, this strategy quickly spiraled out of control, unleashing consequences that few saw coming. When Washington implemented a decisive 20% tariff on Chinese goods, the goal was clear: force China's hand in trade negotiations. Instead, Beijing swiftly retaliated, dramatically cutting imports of American goods, including critical sectors like agriculture, manufacturing, and especially energy. Previously, the U.S. was China's leading supplier of crude oil and liquefied natural gas, LNG, driving billions in trade and fueling China's rapid growth. But in March 2025, America escalated tensions further, imposing a 10% tariff on Canadian oil imports to gain leverage over Ottawa. The strategy backfired dramatically. Instead of bending to U.S. pressure, Canada immediately pivoted, forging a lucrative new partnership with China. This unexpected shift couldn't have come at a better time for Canada. Leveraging the newly expanded Trans Mountain Pipeline, Canada rapidly boosted oil exports to China, tripling pipeline capacity to nearly 890,000 barrels per day. Almost overnight, half of Canada's crude oil exports shifted toward Asia, dramatically weakening China's reliance on U.S. energy suppliers. But the energy shakeup didn't stop there. Liquefied natural gas, LNG, another cornerstone of U.S.-China trade, also faced massive disruption. With Washington aggressively imposing tariffs and restrictions, China eagerly sought alternatives, and Canada was ready. The massive LNG Canada project, starting operations in 2025, positioned Canada as one of North America's largest natural gas exporters. Long-term energy contracts quickly followed, solidifying Canada's critical role in supplying China's energy needs. For American energy companies, this is a disaster. Billions of dollars in revenues vanish almost overnight, and new markets in Europe or Asia are already saturated with competition. American suppliers struggle to replace the scale of demand China once provided, while Beijing's shift to Canadian energy sources may lock in trade patterns for decades. But energy is only part of a larger story. In agriculture, the impact is devastating. China, historically the largest buyer of U.S. soybeans, wheat, and corn, turns instead to South America and Europe. American farmers, once thriving, now face plummeting prices, forced production cuts, and even bankruptcies. The loss of China as a stable market is reshaping the entire U.S. agricultural landscape, causing ripple effects that will be felt for years. Even the tech industry isn't immune. Companies like Tesla, Google, and Intel, previously dominant in China's market, are losing ground rapidly. Canada and Europe capitalize on America's trade conflicts, swiftly taking advantage to secure new contracts and stronger trade relationships with China. The situation escalates further when former President Trump's offhand comments suggesting Canada could become part of the U.S. sparks widespread outrage across Canada. Coupled with aggressive U.S. tariffs, Canadian provinces retaliate by boycotting American goods and services. This severely impacts sectors like tourism and manufacturing in key U.S. states, further straining economic relations and pushing Canada closer to Europe and China. At NATO and EU summits, Canada seizes the moment, presenting itself as a reliable and stable alternative to the U.S. With a strong manufacturing sector, abundant energy resources, and a rapidly growing aerospace industry, Canada strategically redirects European trade flows away from America. European nations, looking for stability amid ongoing U.S.-China tensions, eagerly accept Canada's overtures. One of the most symbolic blows to American business is Canada's unprecedented 100% tariff on Tesla vehicles, crippling sales and sending shockwaves through the electric vehicle industry. The immediate impact on Tesla's profits and stock value is severe, causing uncertainty in the broader automotive sector and creating opportunities for European automakers to fill the gap. What started as a targeted trade war now risks permanently isolating the U.S. economically. China's strategic diversification to Canada, Europe, and other BRICS nations could set new trade standards that diminish American influence on the world stage. If Washington fails to adjust its approach, it may face isolation, losing critical trading partners and weakening its global economic power. In the end, this is about more than trade tariffs. It's a seismic shift in international economics, one that the U.S. may have inadvertently accelerated. Whether Washington adapts or doubles down on these destructive policies will determine America's place in the global economy for decades to come. If you enjoyed this analysis, don't forget to like, subscribe, and share your thoughts in the comments below.